Hey everyone, welcome back to the channel, your number one source for income-oriented investing. And I was on the internet and I came across this really cool interview of the man himself, the Wolf of Wall Street, Jordan Belfort, who's promoting a new book, I guess, The Wolf of Investing. He did a podcast with Michaela Peterson, Jordan Peterson's daughter, and I was actually looking at the YouTube chapters and I saw some really interesting ones. The first half is really about business, this and that, but there's some points in certain section of the interview where he's talking about financial advisors, and I have to say, I agree 100% with what he's saying about financial advisors is that, they're pretty much useless, and why they're useless and why they could hurt you. So I isolated the parts where I thought would be interesting for you. So I know a lot of you either have had financial advisors, got out of it to do it yourself investing. Maybe you know people who are in it. Maybe you're still with a financial advisor. So hopefully this information is useful for you. Let's listen into this, what he says. And basically she just asked him right now, what do you think of these financial advisors? Let's listen to what he says.
The problem is that we've been trained and conditioned to seek out experts to help us solve our problems, eliminate pain from everything, whether it be psychology, medicine, the legal world. We've been taught, rightfully so, that when you have a problem, seek out an expert, right? Alas, Wall Street's the one exception where the experts are going to cause you to do far worse than you would do if you just did it yourself, because the stock market's a funny place. It's like this vast sort of entity where there's all the information on individual stocks is readily available to everyone at the same time. So unless you have some sort of edge, like you're working at Goldman Sachs with lightning fast computers on the exchange that are front running everybody in this sort of ultra short-term trading, the average person that tries to short-term trade, or the average money manager that tries to beat the market, so to speak, the S&P 500, after their fees, their commissions, and the pressure they're under to actually engage in some short-term trading, because you want to see, if you give your money to a money manager, you expect to see them do something, not just, I'll buy the S&P 500 an index, right?
Most of them don't even do anything anyway.
So what happens when it comes to Wall Street and investing, experts work against you. They actually cause your returns to go down, not up. And this has been proven scientifically, mathematically, with study after study after study. It's like the best and worst kept secret at the same time, that the most surefire way to really build wealth over time is through long-term investing and, buying something like the S&P 500, which in a fund that is ultra low fees, which is very tax efficient, and balancing that with some other investments as well, but primarily that, and engaging in speculation with just a small amount that might have some fun. Hopefully, maybe you can make a hit or not, but chances are you might lose more than you'll make in speculation. But this is obvious to people that really know the deal on Wall Street. But, if you turn on CNBC, they'll have you think that you should be trading back and forth from crypto to oil to this stock to one sector, from AI into industrials. And by the way, it's a disaster. It doesn't work. It literally does not work. And few and far between those people that actually end up making any money at all, and they certainly don't end up matching the index fund. So for example, if you look at massive studies, I go through this in my book, by the way, and all the mutual funds since the beginning of time, and all the analyst recommendations for individual stocks since the beginning of time, do not beat simply investing in the S&P 500 and reinvesting your dividends and engaging in this sort of long-term investing that allows you to have compound interest work in your favor. And there are a couple of other things which I'll explain as well in this podcast, that is a really simple turnkey solution that even a small amount of money, very small, like $10,000.
So then he goes into, how, you invest long-term over time. So the gist of it, this is really, really good points. He's saying basically that majority chances are you're not going to beat the market. Fund managers are not going to beat the market. Why pay those high fees, those mutual funds? Not only that, but also, like he said, this is why I don't watch BNN or CNBC, reading about stocks and trying to pick stocks and looking at the results. And, there's all kinds of people that keep posting things on Blossom. And I just don't understand why you would stock pick, no matter what your objective is. If it's total return, guys, if your objective is total return, it's not my objective. Return is important, and my objective is increasing income. But if total return is your primary objective, the S&P 500 is probably is going to be your best bet. There's no need to watch the news and stock pick. And like you said, mutual funds, it's all, you get killed by the fees and they don't even beat the indexes anyway. So what is the point? This is why I feel financial advisors are just, I'm not saying they're bad people or they're not nice, but they're just completely useless. You might as well do it yourself, Get an S&P 500, and that's it. That's all you need for long-term growth. And another thing he said, think long-term, right? So that is clip one. I thought it was extremely spot on. Now let's go to a second clip, which I find is very interesting as well. And it's going to ring a bell for many of you. I'm 100% sure. Let's check it out. All right, let's watch a second clip. I apologize if the lighting on my face keeps changing. I think it's just the software. I'll try not to move my freaking head anymore. Can't help it because I'm Italian, right? We like to move a lot, I guess. But let's listen in here.
So Dad got quite a bit of money when he stopped becoming a professor, which is just what happens when you basically retire. And that was immediately taken by a bank in Canada. And then we had a money manager, and it's underperformed the S&P for forever. And the money manager takes their fees and everything. So we're getting away from that. But why is that the norm? Why is a money manager the norm as opposed to just investing yourself? How did that even become a position?
Great question.
Sure. So this goes back, and that's like, one of the things I talk about in the book is something called the Wall Street fee machine complex, like the military industrial complex, which exists to essentially feed on itself. So it's a sort of combination between Wall Street, Washington, D.C., Madison Avenue, and the media, and they create this perception through mass advertising and mass brainwashing that you should be giving your money to the experts in the financial community because they can do a better job at managing your money than you can. Now, here's the irony. That was probably almost true. Well, let's just say managing your money yourself was very, very difficult before 1980. The vehicles didn't really exist. It didn't exist,
That's
okay?
true. We are
and
spoiled,
mutual
guys.
funds would charge you exorbitant fees, but the problem was the average person on Main Street did not have access to information in the same way you did on Wall Street. There was no internet, right? So you read about some things in the Wall Street Journal the next day, yet on Wall Street, they're getting news delivered real time to their desks, and the traders are one step ahead, right? And you also had no index funds. You didn't have an S&P 500 index fund until 1977. So there was an S&P 500, but it wasn't an index fund. It was an index. So there's a very big difference between an index and an index fund. An index is something you could just track. So you say, oh, the S&P or the Dow Jones is up 5% or 3% or 15% this year. Great. So what does that mean for investing? You can't buy the S&P. You couldn't buy the S&P 500 or the Dow. Didn't exist. So the only way you could then take advantage of the general stock market was have a stockbroker or money manager that had the capabilities in the in-house research departments and the execution abilities to go out there and buy these big stocks and keep themselves informed. So yes, in this 40s, 50s, 60s, 70s, maybe in the 80s, it started to change, right? But what happened is in the 80s, with the beginning of Vanguard was the first one to have an S&P 500 index fund. It was a game-changing moment in the stock, game-changing. It changed everything. And in fact, Wall Street did everything they could to suppress it. They smeared Vanguard. They smeared the founder, Jack Bogle, called him a fraud. They did everything they.
Yeah, so there you go, guys. So this is why I keep saying, and I've said it before, we're absolutely spoiled for choice. We have no excuse. It's 2023. It's going to be 2024. There's so many amazing brokers that are low fee or even zero fee, like Wealthsimple. It's so easy to buy and sell these great index funds. It's not just Vanguard now. Everyone has BlackRock and Vanguard and BMO. They all have S&P 500s. Now we're even as income investors, the last 3 years was a game changer because we have even index-based covered call ETFs, leveraged ones. Horizons just came out with index-based covered call leverage. So basically what he's saying is that now there's no need for these financial advisors. You could just do it yourself. And the analogy I typically like to use is at the gas station, right? Why pay more for a guy to pump your gas or the full service when it's the same gas? So the S&P 500 is the same stocks, right? In those mutual funds that they pick and choose, they charge a high fee. So what's the point? There's no point. You might as well go with an index fund if you're looking for a total return. S&P 500 in the US, a TSX 60 in Canada, et cetera, et cetera. And I love the part where Michaela, talks about her dad. And it's a typical story, right? You go into a bank, you give it to a financial advisor. It's no longer needed. It just hurts your return over time. Now, the last clip, very small, he talks about indexes. So let's check it out real quick in case, because in my opinion, I'm really starting to love more and more and more index style investing. Now you could even, as an income investor, you could do index style of investing as well. So let's hear quickly what he says about indexes.
You don't have to even deal with any of the short-term stuff. You have to take a long term view of the market. Let Wall Street do all their work in creating value, taking companies public, providing them with financing, taking advantage of all that stuff, but you don't trade in and out of things. You hold the S&P 500, which, by the way, changes. The 500 companies in the S&P 500 today are not the same ones that were there last year. Not all of them. Every quarter, the index committee meets and they remove companies that aren't doing as well or becoming less relevant. They change the weighting of each sector. So, as the economy moves to more of a computer informational economy, the S&P is made up more of those stocks versus industrial stocks, right? So you have 50,000 employees or 35,000 employees at the Standard & Poor's working every day, tirelessly.
Yeah, so S&P stands for Standard & Poor's. These are the people managing the indexes and deciding what are the 500 companies. This is what he's talking about, right? So this is why I love index investing, because it always moves. You're always sure to have the biggest and best stocks all the time. That's why it's so convenient. You don't have to get in and out of things, right?
To try to come up with these best 500 companies, and then you have a company like a Vanguard or whatever, or like competitors that have created this ultra low cost index fund, and you could just buy that. And you sidestep all the bullshit that Wall Street and the fee machine complex is slinging at you.
And that's it, guys. So, very cool point talking about indexes here. So if we summarize, right, the lesson learned is that you're much better off with an index fund if you're looking for total return. You don't need a financial advisor to tell you to buy you an S&P 500. You just buy it yourself. It's pretty much free now or very, very low cost. There's no point getting in and out of things. You got to have a long-term view of investing. What's the point of going on BNN and MSNBC? All they're talking about is short-term crap, which next week could be different. They're predicting 100% useless. So guys, I thought this interview was really cool. Again, half of it is really business. It's really, I'll put the link in the video description below. I strongly suggest you check the YouTube chapter so you could get on, there's a lot more stuff he talks about, but I think I tried to isolate the three important topics or clips when it comes to investing, but you could check it out for yourself. I thought it was really cool. And if you like these type of videos, let me know in the comment section below, because sometimes I do see some Q&As and some interviews with people who really know what they're talking about or actually saying the truth, and let me know and I could do more of these commentary videos. So hopefully this was useful. Hit the thumbs up. I would appreciate it. And yeah, see you next time. Hey, don't go yet. A few reminders before you leave. Did you know that I launched a YouTube loyalty membership program where for only $3 a month, you could become a PII Inner Circle member, where you will gain access to exclusive content, exclusive videos and live streams, as well as other perks and benefits, including a really cool weekly opportunity report. That's right. If you're interested, just click on the little join button next to the subscribe button to see what it's all about. Also, make sure to follow me on Blossom and download Blossom. It's a social investing app, which is really cool. You could share your portfolio, follow other people's portfolios, including my own. My username is Adrian_PII. So download it with the referral link below. Not only is it free, but you could actually earn cash by taking these really small, quick 1-minute courses. Really awesome. It's a no-brainer. Also, make sure to visit our website, PassiveIncomeInvesting.ca. That's where you could book a one-on-one private coaching session with yours truly, with myself, where you could ask me all the questions you want. All the information and booking information is on the website. Make sure to check out that video on the homepage there to see how to book a one-on-one properly. Also on my website, you could purchase my digital product, which I'm very proud of, the ultimate DIY investing package. This is a reference tool or a companion tool that will help you build your own portfolio. So it has lists of funds, it has sample portfolios, and it covers both the Canadian and US stock markets. And the good news is you'll only ever have to buy it once, because it comes with free lifetime updates. And my plan is really to update the version every single year. So make sure to pick it up. Also, I have Questrade and Passive referral links below. So Questrade is the broker that I personally use, and Passive is the broker companion tool or companion or assistant that I use. Really cool program, really cool software. So I have referral links for both of those. Questrade, $50 of free trades. And Passive, I have half off for the elite membership. If you're interested in the elite membership, and even if you want to start out with the free membership and upgrade to the elite afterwards, use my referral code so you could still get that 50% off. And don't forget that the elite membership of Passive is 100% free if you use Questrade. For social media, we have a very successful and big Facebook group, private Facebook group with over 14,000 members where we all try to help each other out. So make sure to join that group. Information is below. We also have Instagram where you could follow us or more personal stuff when it comes to our life here in Panama. And there's LinkedIn as well. So as usual, everyone, how do I leave you? Continue to stay safe, stay healthy, and of course, stay passive. See you next time.